This chart tracks the total value of global stock markets over the first half of 2026. Within a single month, Taiwan's market capitalization surged, overtaking both the United Kingdom and Canada to top $4 trillion. On May 25th, Taiwan's valuation climbed to $4.95 trillion, pushing past India's $4.92 trillion threshold, making it the fifth largest equity market on Earth. To understand why that ranking is so unusual, we have to look at the underlying economies. India generates a gross domestic product of over $4 trillion. Taiwan's total economic output is less than $1 trillion. Historically, a nation's stock market was expected to serve as a mirror, reflecting its economic footprint. That value was tied to the scale of a country's domestic life, its massive consumer bases, its physical infrastructure, and the reach of its local banking systems. But the link between the size of a country's real economy and the value of its financial market has just been severed. While India's market is built on the needs of 1 billion people, Taiwan's valuation is now driven almost entirely by the concentration of its high-tech exports. This rise isn't a broad economic miracle. It is a $5 trillion bet on the artificial intelligence supercycle, concentrating nearly all of the island's value into a single microscopic sector. At the center of that concentration is Taiwan Semiconductor Manufacturing Company, or TSMC. It has become the primary choke point for the global technology stack. When companies like Microsoft, Google, and Meta commit hundreds of billions of dollars to AI infrastructure, those funds eventually flow into TSMC's order books to pay for the silicon that makes that infrastructure possible. There is currently no alternative. These hyperscalers are dependent on TSMC's exclusive 2nm and 3nm fabrication nodes to build the next generation of advanced chips. This shift in where capital is moving has left traditional emerging markets like India struggling to maintain their momentum. India's core problem in this current cycle is a lack of direct exposure to the specialized hardware supply chain that defines the AI build-out. Instead, India remains vulnerable to the rising costs of energy. Because the country imports nearly 90% of its crude oil, geopolitical friction in the Middle East translates directly into domestic inflation and currency weakness. The market reaction has been swift. As TSMC's stock surged 49%, foreign investors pulled nearly $24 billion out of Indian equities. In search of higher returns, global investors are moving their capital out of diversified, consumer-driven economies to chase a single hardware monopoly. Local policy changes inside Taiwan have accelerated this trend, creating a feedback loop that further concentrates the market. This chart shows how domestic fund rules were recently adjusted. Previously, a fund could only hold up to 10% of its assets in any single stock. That limit has now been raised to 25%. TSMC is the only company large enough to meet the new criteria. That sparked an automatic buying spree as domestic fund managers adjusted their portfolios to keep up with the index. That rule change alone pushed an estimated $6 billion into TSMC, bringing its weight to 42% of the entire Taiwanese index. The National Stock Exchange is no longer a diversified list of companies. It has been effectively swallowed by its largest component. This tree map shows the MSCI Emerging Markets Index. Taiwan now accounts for nearly a quarter of the global benchmark. Within that index, TSMC alone carries a 14.2% weight. A single semiconductor firm now carries a larger index weight than the entire nation of India. But the same concentration that built the world's fifth largest stock market also leaves it exposed. Because the market is so heavily weighted toward hardware, any sudden pause in AI spending or a minor disruption in the supply chain would create an outsized shock to the entire system. Then there's the risk that cannot be modeled. A military escalation in the Taiwan Strait would immediately impact nearly $5 trillion of concentrated capital. The rules of valuation have changed. In this new landscape, the computing requirements of a handful of companies carry more weight on a global index than the total economic output of a nation like India.